Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharey. Thanks for tuning in. So I used to think that popping my knuckles would cause arthritis. That's because my mom told me it would, and her mom told her it would. Turns out there is no study existing that supports this theory. This little bit of conventional wisdom is neither conventional nor wise. And, thinking about it, it was probably fabricated by some mom out there who was sick of hearing her kid snap his knuckles because, that's annoying. By the way, my mom also told me that all of the bread's vitamins, or most of the bread's vitamins, were in the crust. So I needed to eat the crust to get the vitamins. This is also a fabrication, by the way. The vitamins don't magically migrate to the top of the bread. But apparently the mother's handbook of that era said it was a way to possibly get your kids to eat the crust. So all of this just goes to show that just because something is oft repeated and widely believed doesn't make it true. Kind of like the current narrative surrounding gold and silver right now. So before I get into all of that, I do want to thank you so much for listening to the show. I say this every week. I mean it from the bottom of my heart. I know there are all kinds of things vying for your attention, and I appreciate the fact that you spend a little bit of time with me each week. And, as always, if you would do me a favor, I would really appreciate it if you would share these episodes on your social media platforms. And also, go to wherever you listen to the podcast and write a little review. Give us those thumbs up or those stars. That will help the algorithm and it helps spread the word about the show. And if you would do that, I would say thank you very much. So, what's wrong with this picture? If you follow the markets, you know that gold and silver has faced pretty strong downward pressure for weeks. Really, it's been trading sideways, kind of in a range, but it feels like the momentum keeps getting pushed down. Every time that gold and silver kind of regain a little bit of momentum, you get some kind of bad war news and everything unravels. So the yellow metal has dropped more than 11% from its all-time high of just over $5,102 an ounce back in January. And as I said, selling pressure continues to dominate the market. The bulls just can't seem to get a foothold back in there. And there's a well-established mainstream narrative that is driving this bearish sentiment. However, while seemingly plausible on the surface, this mainstream storyline is missing two extremely important dynamics. So what is the prevailing narrative? What are most of the mainstream people saying about precious metals? Well, according to the prevailing narrative, the Federal Reserve will have to keep interest rates higher for longer to control the inflationary pressure introduced into the economy by skyrocketing oil prices due to the U.S.-Iran war. And some people think that the central bank may even need to raise rates this year to combat that inflation, especially if the war continues to linger on. As the mainstream analysts typically put it, quote, higher rates are negative for gold because it is a non-yielding asset. I guarantee you, if you've listened to any of the mainstream financial networks, if you've read any of the mainstream, financial analysts, that's what they're saying. Higher interest rates, negative for gold, non-yielding assets. In other words, since gold doesn't pay interest or dividends, investors are going to spurn the yellow metal to chase increasing yields in the bond market. And this is why every time there is any bit of negative news on the war front, gold tanks, and why any kind of murmurs about a peace deal sends gold and silver both higher. It's this mindset that if we can get rid of this war, then inflation's going to be fine, and the Fed can go back to cutting like it was before. So, it's interesting to me because the fact that the news cycle is pushing gold up and down tells me something. It tells me that really, absent this war situation, gold and silver want to go up, right? The war is holding it down. the sentiment surrounding the war is holding it down. It's like the lid on a shaken up bottle of Coke, right? When the lid is removed, gold will likely be free to resume the upward trajectory we've seen over the last couple of years, because all of those dynamics are still undergirding it, right? We still have de-dollarization. We still have massive levels of debt. We still have a lot of shakiness in the economy. We still have inflation pressures. Gold is an inflation. And so all of these things, central bank gold buying, all of that stuff is still in place. We've just got this war and this inflation worry that is holding it down. Now, if you think about this, if you just kind of look at it from the surface, this mainstream narrative sounds perfectly reasonable, right? I can kind of listen to it, go through each point, nod my head, think, yeah, makes sense. If the war continues and inflation continues to mount, gold should be lower. However, the mainstream pundits aren't getting the full story, and two key dynamics are missing from this mainstream narrative. And this is why I think even if the war lingers, we're still going to see bullishness in the gold market at some point. It's going to break out of this narrative because, quite frankly, the narrative is wrong. So what are the two dynamics that the mainstream seem to be leaving out of the discussion? Number one, they are ignoring real interest rates. And number two, it's far from certain that the Fed will keep rates higher for longer, even if the war continues on, even if inflation continues to heat up, because we have the massive debt black hole. So these two factors need to be taken into consideration when you're listening to this mainstream narrative. So let's look at both of these dynamics just a little bit closer. So right now, mainstream analysts are fixated on rising interest rates. As I said, rising interest rates are bad for gold. But when they talk about rising interest rates, they're almost always talking about nominal rates. However, the real interest rate is far more important when determining the income-generating potential of an asset. So what exactly is the real interest rate? Well, it's pretty simple, to be honest. The real interest rate is the stated rate you see on the news or in the paper. I just dated myself online, adjusted for price inflation. So to calculate the real interest rate, you take the quoted nominal rate and you subtract the CPI. And this tells you how much your investment will yield in real purchasing power over time. So let me give you an example. Let's take a 10-year Treasury bond and say it is currently yielding just over 4.6%. So that seems like a pretty good return, and that's roughly where we've been over the last week or so. However, the CPI is running at 3.8%. So to calculate the real interest rate on a 10-year Treasury, you take 4.6%, the interest rate, subtract 3.8%, the CPI, and you come with 0.8%. So that is the real interest rate, 0.8%, not even 1%. That's hardly a reason to spurn gold or silver, right? So that's the problem. They're looking at this 4.6%. They're saying, ooh, great yield. They're not calculating in the inflationary pressure, so they're missing the real interest rate. Now, note this. In a low interest rate environment, or if price inflation is particularly high, real interest rates can go negative. And quite frankly, they spent a lot of time negative over the last couple of decades. So if price inflation rises to 5%, certainly not an unreasonable target given the oil shock, the real interest rate would be negative 0.4% if we hold that Treasury bond yield constant at 4.6. So in other words, you would lose money in real terms holding a 10-year Treasury, even with a 4.6% yield, if price inflation rises over 5%. So you can see how important this real interest rate is. You can't just look at the nominal rate that they're quoting on TV and saying, ooh, interest rates are high. You have to calculate the inflation. And as the CPI goes up, real rates are going down, again, assuming bond yields are holding steady. So the point here being is that bond yields aren't as attractive in real terms as you might think just looking at that nominal yield. And the mainstream pundits are pretty much always just looking at that nominal yield. You rarely hear them talk about real interest rates on, Fox Business or CNBC or any of these other financial news networks. Now, I need to give my CPI statement or my CPI disclaimer at this point, right? I say this every time I talk about the CPI. The actual inflation rate is much higher than the CPI reveals. I say this all the time. The government revised that formula in the 1990s so that it understates the actual rise in prices. So if you go back and you take that formula for CPI that they used in the 70s, and you can do that. There's a website, I can't think of the name of it off the top of my head, but there's a website where they calculate CPI using the old formula. And when you do, you will find that CPI is closer to double the official numbers. So, if the BLS used the old formula, we'd be looking at CPI right now closer to 6, maybe 7%. So in those terms, real rates are already deeply negative. And, honestly, the 70s formula probably wasn't accurate either. The inflation is probably even worse than that. And, those of you who are living inflation in real time know this. So, all of that to say, this means the real interest rate is generally lower than the calculation even indicates. So, it should be obvious that 0.8%, not a great return, especially when you factor in the potential for negative yields in the near future. This is not a good reason to dump gold and buy treasuries. So, that's the first dynamic that seems to be missed by the mainstream. The second one is I'll put it in form of a question. Can the Fed really hold interest rates higher? That's the assumption. That's what everybody thinks is going to happen. And it makes sense. CPI is going up. Therefore, the Fed's mandate is to keep price increases under control. Ostensibly, they don't do a very good job of it, but that's what they're supposed to be doing. So therefore, they're going to hold rate higher or maybe even raise rates in order to tamp down this price inflation. So, most people just assume that the central bankers over at the Fed are going to see the hot CPI data, they'll hold rates higher, maybe raise them. Again, it's not that simple, right? The economy right now is dominated by a debt black hole. My good friend Greg Weldon kind of coined that term. I think it's the perfect description because if you know anything about physics, astrophysics, a black hole dominates everything that's around it. Its gravitational force is so strong, it sucks everything into it, even light. So we have a debt black hole. It's sucking everything in the economy into it. And a debt black hole does not play well in a higher interest rate environment. In other words, keeping interest rates elevated risks crashing this debt-riddled bubble economy. And we've been on this precipice for quite a while. I've talked about it frequently on the show. I've talked about the fact that we never really kind of rinsed out all of the malinvestments and the financial malfeasance that happened during the 2008 financial crisis because the pandemic kind of gave them a pass and allowed them to double down on stimulus and actually made the situation even worse. So we have the maladjustments and the misinvestments and all of those things from 2008 still rumbling around out there, plus all of the malfeasance that occurred during the pandemic era. All of that at some point has to be unwound. That debt black hole at some point has to pop. It's going to. So that's where we are. Again, this is something that the mainstream just doesn't pay any attention to. And as I have put it over and over and over and over again, the Fed is in a catch-22. And when push comes to shove, I believe the central bankers are going to abandon the inflation fight to rescue the economy. And that's something that nobody in the mainstream is talking about, at least not that I know of, maybe a few people out there. But, the central bank right now is already struggling to control the yield curve, especially the long end. U.S. government borrowing costs are shooting through the roof, right? Every time those interest rates go up, good news for bond investors, not good news for the U.S. government that's trying to borrow money and keeps seeing its borrowing costs spike upward. So the Fed has actually restarted quantitative easing, although it's never going to use that term to put its big fat thumb on the Treasury market. So what happens when the higher rate environment pops the bubble. If they do try to hold rates as high as they can, and it does end up crashing the economy. Well, we know the Fed's playbook because we've seen this movie 3 times already, right? We've got the dot-com bubble, we've got the 2008 financial crisis / Great Recession, and then we have the pandemic. What do the Fed people do when there's an economic crisis? They cut rates. They buy treasuries and mortgage-backed securities. They print money. They create inflation. So the Fed ultimately is faced with a choice. It can keep on fighting the inflation dragon, or it can surrender to the inflation dragon and try to keep the debt bubble inflated and the economy tottering onward. It cannot do both. It is trying to do 2 things that are mutually exclusive. And history tells us that the Fed will pick inflation. Now, of course, it's not guaranteed. We have a new Fed governor in Kevin Warsh. Maybe things will play out different this time, but I'll have to see it to believe it because monetary easing is the fork they know. It's the only utensil in the drawer, quite frankly. So the bottom line is you need to take this mainstream narrative about gold and inflation with a grain of salt. It is not as cut and dry as your CNBC and Fox Business pundits would like you to believe. And you should not be selling your gold every time you think that maybe this war is going to linger on a bit because these other dynamics are in play. And I've talked about this before. A war itself historically has had very little impact on the trajectory of precious metals prices. You have an initial bump of safe haven buying. It tends to settle out. You actually, historically, in these big crises, you've seen a drop in gold and silver prices before they begin to rally later on. So, it's not as simple as the mainstream narrative. There is something wrong with their picture, and you've got to keep all of that in mind as we move forward. And this is why I talk about all the time. You want to keep that inflation hedge, right? I think you should always hold at least some gold and silver in your portfolio to hedge inflation because inflation is always there, right? It's not going anywhere. So, I know a lot of folks, when I start talking about investing in gold and silver, protecting your wealth with gold and silver, a lot of folks think, I just don't have it in my budget. I just can't fork out $5,000 to buy an ounce of gold. I really can't spend a lot of money to buy silver. I got to pay for groceries and stuff. And I totally get that. That's the difficult world we live in, right? When prices keep going up and up and up. But it's still imperative to do what you can to save and protect your wealth. And at Money Metals, we have a program that can help with that. It is a monthly purchase plan where you can buy gold and silver over time for as little as $100 a month. So every month, it just comes out of your account. You get the gold and silver. It's stored in our state-of-the-art bullion facility, and you can build that over time. So go to moneymetals.com and check out our monthly purchase program because it's a great way to save. Again, as little as $100 a month. And it's an investment that will pay off in the long run. So check that out whenever you get a chance at moneymetals.com. Or if you have questions about it, you can call 800-800-1865 and talk to one of our fine precious metals specialists. So I keep saying that inflation is never going away. And you may be thinking to yourself, Mike, why do you keep saying that? Why are you so pessimistic? We could slay the inflation dragon. It's certainly possible. Well, I keep saying that because as far as government people go, inflation is not a bug in the system. It's a feature. Now, we talk a lot about sound money around here at Money Metals. It's what we do, right? We believe in sound money. That's why the company exists. We believe in this, I hate to use the term product, but we believe in real money. We believe in gold and silver. And when we talk about it, we primarily focus on the financial impacts of unsound money on the American people, right? It steals your wealth. It robs you of purchasing power. It is particularly devastating for the poor and folks on fixed incomes because their income can never keep up with inflation. Some people will try to tell you, well, inflation isn't that bad because, wages eventually catch up. Yeah, eventually. But in the interim, you're getting hosed, right? And there is another pernicious aspect of fiat money that gets a lot less attention. Fiat money systems facilitate big government and they erode individual liberty. Economist Ludwig von Mises believed it was imperative to understand this aspect of the fiat money regime. And he argued that sound money is actually a bulwark for liberty, and he put it in the same class as a constitution or a Bill of Rights. These are things that are supposed to restrain government and protect the people. Mises wrote, "It is impossible to grasp the meaning of the idea of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against despotic inroads on the part of governments. Ideologically, it belongs in the same class with political constitutions and bills of rights." And I absolutely agree with him on that. Sound money is the biggest restriction on growing big government, right? Sound money restrains governments. But without restraints, people will always use and grow government power for their own gain, to the detriment of the people. Historian Tom Woods described how unsound money leads to a multitude of problems far beyond the realm of finance. Because think about it, money impacts virtually everything that we do, right? Tom wrote, "The destruction of sound money around the world has laid the groundwork for the destruction of so much that is good and beautiful. There are so many bad trends in fields as disparate as science, food, architecture, and family life, and a great many more besides, that can be traced back to bad money. And it is at the root of why no matter what we try, the world's bloated regimes cannot be kept under control." Man, Tom packed a lot into that paragraph, right? So think about it. Because the government is so big and intrusive, it is warping science. It is warping food. It is warping architecture. It is doing a lot of things that people should be doing on their own as communities, right? As human action brings these things about, not being dictated by government. And he's also absolutely correct that the lack of sound money is why we cannot keep these bloated regimes under control, because they always have the tool at their disposal to make themselves bigger and more powerful. So this explains why inflation is so relentless. Now, every once in a while, it becomes so bad that the government policymakers have to make a show of bringing it down, right? That happened after the COVID episode. But they don't want to end inflation. In fact, inflation is the plan. Simply put, the ability to print money is power. And I've often said that the Federal Reserve is the engine that drives big government. You know, sometimes people will play the game. If you could just get rid of one government entity, what would it be? You know, it would be the IRS or the Department of Defense or Department of Education. You know, which one do you think we could get rid of and make the most progress? I absolutely, every single time, would say the Federal Reserve. That's because the U.S. Central Bank facilitates money creation. That's how it works in our system. The Treasury doesn't actually print money. It's the Federal Reserve that's doing that job. Without the relentless money printing and the Fed's mechanizations within the bond market, the U.S. government wouldn't be able to borrow and spend to the extent that it does. That means that without currency debasement, the government would actually be smaller and less intrusive. And, you know, the reality is the American people would not accept the level of taxation necessary to maintain the welfare warfare state that we have today. If all of the money had to come from taxation, you'd have to raise taxes on everybody, rich all the way down to the poor. Because, you know, we talk about the deficit. I write about the deficit every single month. It runs between, you know, $200, $300 billion a month. Every single month, they're spending that much more than they're bringing in, right? So they're having to borrow all of this money because there's no way that they could tax it all. And of course, the Fed facilitates the borrowing. Benjamin Franklin recognized inflation, or they actually called it depreciation, because that's what it's doing. It's the depreciation of your purchasing power. But he recognized inflation as a tax more than 200 years ago. Franklin wrote, "The general effects of the depreciation among the inhabitants of the states has been this, that it has operated as a gradual tax upon them. Their business has been done and paid for by the paper money, and every man has paid his share of this tax according to the time he retained any of the money in his hands and to the depreciation within that time. Thus, it has proved a tax on money." Gouverneur Morris was another influential founding father who most people have never heard of, but he was very important, especially in the ratification of the Constitution, and he made a similar observation. He wrote, "The resources of the country may be drawn forth by our paper. At the same time, it must be confessed that this paper will thereby be less valuable. After all, the debt does not increase for a certain sterling sum which would have paid it 1 year ago will pay it now. The depreciation in the interim hath operated as a tax." Now, of course, in modern America, the government doesn't just print off $100 bills and spin them. The process is much more complex. But it is a continuation of something that governments have done for time immemorial, right? The Romans depreciated their money by actually clipping gold out of the coins. They would clip the coins to have less gold and then, say the coin has the same face value. Or they would melt down the coins and mix in other metals to dilute the content of the gold in them. So money depreciation, this inflationary process, has been going on forever. With the advent of paper money and the printing press, it got that much easier. And now it's even easier because, they can do this stuff with the click of a few computer keys. So what is the process in the U.S.? Well, first, the government borrows money by issuing bonds, right? It taxes, can't get enough money to cover its spending, so it has to go and borrow. And the central bank can lower those borrowing costs by keeping interest rates artificially low. This also incentivizes private borrowing, which expands the money supply in a fractional reserve system. So that's why I always say that artificially low interest rates are typically inflationary, because it is incentivizing money creation. Now, keep in mind, and I say this all the time, I probably say this every week, but it's important and it's something that most people have not wrapped their head around yet. Inflation is not merely rising prices. The CPI is not measuring inflation. It's measuring a symptom of inflation, right? It's just like a thermometer is not measuring the flu, right? It's measuring your temperature, which is a symptom of the flu. The CPI is measuring a symptom of inflation. Historically, economists have defined inflation as an increase in the supply of money and credit. So rising prices are one symptom of this. So what is the central bank doing when it pushes interest rates artificially low? It's stimulating credit. It's increasing the money supply. This is inflationary. And this inflation is ultimately going to show up in the economy. It may show up in the form of higher consumer prices like we saw after the pandemic, but a lot of times it doesn't, right? In 2008, the banking system held most of that newly created money within itself, and we saw the inflation in asset prices, in real estate, in the stock market, and a lot of that inflation is still going there today, right? So if we have a crisis, the Fed can get even more aggressive by launching quantitative easing, or QE operations. And when this happens, the central bank buys some of those bonds out on the open market. So it goes out there and says, hey, we're going to buy some treasuries. This creates artificial demand for U.S. debt, right? The Fed is buying treasuries, therefore other people can't. And this is known as debt monetization. They're literally turning the debt into cash. And it allows the government to borrow more at a lower interest rate than it otherwise could. So you start to see the problem in this context with the debt black hole, right? Because the government needs the Federal Reserve to hold interest rates artificially lower. It needs the Federal Reserve to buy bonds with money created out of thin air in order to facilitate borrowing and spending, right? That's what the Fed does. But here's the catch, and I've alluded to this. The Fed buys those bonds with money created out of thin air, right? It's not like it goes and it has this account with a bunch of cash in it, and it goes and writes a check and then transfers some of that cash over to ABC Bank, and then ABC Bank, gives the Fed the Treasury. It's not how it works at all. The Fed doesn't have any money. It writes a check on an account with basically a zero balance, and poof, money appears out of thin air in the account of the bank that's selling the bond. That is money creation. That is money printing. They're not literally printing it, but it's the same effect. It is increasing the money supply. And this, ladies and gentlemen, is why government people love fiat currency, and it's why they hate gold and silver. A gold-backed or a silver-backed system restrains money creation. This is exactly why FDR had to go through all of the things that he did back in the 1930s, gold confiscation, all of those things, because there wasn't enough gold to back up the money creation that he wanted to do. So he had to get more gold. So he took the public's gold and he repriced gold, and he did all of these things that were in effect inflationary. And he did that because he had no other mechanism. So ultimately, they just got rid of the gold because that makes it a lot easier. There's no barrier in the way. No mechanizations have to be done. And that is where we are today. So if you want a perfect example of how fiat money facilitates government spending, look no further than the pandemic era. The Federal Reserve monetized nearly all of that massive debt. And there was a lot of it. Trillions of dollars the government handed out in stimulus. Spending. Massive deficits. Massive budget shortfall. So they had to borrow a lot. And the Fed monetized all of that debt to facilitate that borrowing with nearly $5 trillion in QE. It bought nearly $5 trillion, mostly treasuries, some mortgage-backed securities. And it injected $5 trillion of new money into the economy. So those billions in stimulus, we paid for that a few years later at the grocery store and the gas station. This monetary malfeasance would have been impossible in a sound money system. Simply put, sound money checks government growth by restraining borrowing and spending. If the Fed had not been there to absorb all of that borrowing that happened during the pandemic era, the financial system would have collapsed. We would have had interest rates spiking to the moon, right? But the Fed kept that from happening, and the trade-off was inflation. And this is why I said earlier, this is the fork that the Fed knows. This is what the Fed does. It's how it deals with these situations. So, here's the bottom line. If you want limited government, freedom, and liberty, you have to support sound money. In a fiat system, government will inevitably grow, swallowing up more and more of the private economy, crowding out liberty, and grinding the citizenry into poverty. In an unbacked paper money system, the only check on the growth of government becomes the ultimate collapse of that currency. This unholy union between big government and unsound money trickles into every area of society. As economist Seyfeddin Amos argued, I'm sure I just butchered his name, I'm sorry, but he said the incentives inherent in a fiat system drive significant societal shifts that are overwhelmingly negative. So go back in time. In a letter to Jabez Bowen of Rhode Island, George Washington may have summed up the long-term impact of fiat systems best. Washington wrote, "Paper money has had the effect in your state that it ever will have, to ruin commerce, oppress the honest, and open a door to every species of fraud and injustice." And this, ladies and gentlemen, is why we push so hard for sound money. Sound, honest money is integral to a healthy, functioning society. We have neither right now. And we can trace so many of the issues that we have to this fiat money system. Unfortunately, it's not going to go anywhere. I don't think that there are very many politicians who are willing to take on the pernicious fiat money system. They're going to be labeled as kooks and cranks. A lot of people listening to this show out there in the mainstream will say, well, that Meharry guy's just crazy. This is all crazy talk. Fiat money is great. It's the best thing that's ever happened, right? That's what they're going to say. But the fact that we can't really do anything about it doesn't mean that we can't shield ourselves from some of its effects. We can have real money, right? Nobody's stopping you from having gold or silver. Nobody's stopping you from protecting your personal wealth from this degradation of your spending power. You can get gold and silver. Like I said, even if you just get it a little at a time through our monthly installment program, $100 a month, right? But you need to have sound money. You need to hold gold and silver. You don't want to save in rapidly depreciating fiat dollars because of everything that we've talked about today. So this is the time, right? We're in a period right now where gold is trading sideways, silver is trading sideways. You're seeing some big dips every time we get bad war news like yesterday, right? Gold falls, silver falls. To me, those are buying opportunities. Those are opportunities to protect your future wealth. So today, pick up the phone, call 800-800-1865, talk to a money metals, precious metals specialist. You've heard me talk about how fantastic these folks are. There's actually a few videos that are out there on our social media platforms now that kind of show where I interview some of these folks and show just the breadth of their knowledge and how good these folks are. So if you're not following our social media channels, you might want to do that. We're everywhere. Facebook, X, TikTok, Instagram, all of them. So look us up there. But yeah, talk to a precious metal specialist today. I know a lot of folks, though, they don't like to talk on the phone. That's fine. You can chat with the precious metal specialist online at moneymetals.com. Or if you know what you want, right, you want to get some gold eagles, or you want to get some silver maple leafs, you can just find those at moneymetals.com. We have a great search function. You can buy online. We'll ship the metal directly to you. Or, again, you can store your precious metals in our state-of-the-art bullion facility. But you want to do it today because inflation ain't going nowhere. They're going to keep inflating. That's what big government does. So take action today. With that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Now, of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, make sure to tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. As always, thank you so much for listening to the show. I do very much appreciate it. I hope you have a fantastic rest of your week, and I'll be back again behind the microphone on Monday.